My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Welcome back, folks. Today, zooming in from Dallas, Texas, we have a very experienced real estate entrepreneur who brings an engineer's mind to this whole game of real estate investing. Sandhya has had a ton of experience as a passive investor and more recently as a more active real estate investor, syndicator, co-GP on a number of deals. And we were talking a little bit off camera about what she's seen over the last 4, 5, 6 years, the big difference between the go times, where basically anybody could get in the game and, the high tide was raising all ships, to today, and the time we're recording this, it's the beginning of Q2 of 2025, the big shifts, the big differences there. So Sandhya, welcome to the show. Great to have you.
Thank you so much for having me, Dave. I'm very excited to be here.
Yeah. Sandhya, why don't we get started? Why don't you give us a little snapshot of your real estate portfolio at this point? What are you involved in? What asset classes primarily, give or take? How many properties or doors are you involved in at the moment?
So I'm an active lead general partner on 5 assets in the Dallas-Fort Worth area today. And They are all Class B and Class C, meaning they were built like in the 80s and 70s kind of properties. And I got into real estate because I'm a very data-driven person, and I was looking for something for depreciation and tax benefits and a business to run on my own schedule. And asset management ties very well with my engineering and project management background. I also have a lot of passive investments, and these are all multifamily deals, mostly with a couple of sprinkles of, self-storage and other asset classes. But my passive investments and active investments, on the active side, I do it all in Dallas, because I've lived here for over 34 years now, and I really know my market. You give me an address, I can pretty much tell you if I'm even interested in that location. But my passive deals are all over the country, depending on the operators.
Very good. So Sandhya, speaking about your active investments, you say you're on the asset management side of things. So do you work with a group of other co-GPs on these kind of projects, or how does the typical structure look like?
So I also underwrite my deals. I also drive the properties. I have 4 brokers living in my neighborhood. So I do all of the above. I don't just do one little piece of it. So if a partner of mine, I usually work with at least 1 or 2 other partners, just from protecting investor capital. If I get hit by a bus, you know who else you could go to as an investor. But if my partner brings a deal and they underwrite it, I will also underwrite it independently myself to make sure we validate the assumptions, because any deal is all about the assumptions you're making. It's the rent growth, the expenses, etc. And I am a hands-on asset manager. I'm the boots on the ground. I'm within 20, 30-minute drive of all my properties. That's very important to me. But all of us have to now raise capital. It's not an optional thing. The cost of capital has gone up, so that's a role we all play. But each of us have our strengths. Like I have a partner whose past experience has been in insurance. So obviously he's our main primary liaison with that. I tend to be the liaison with the lender. And as well as with the property management company. Sometimes all of us jump in on the asset management calls, but I'm usually the primary on that.
Got it. So you're typically working with a small group, yourself, maybe 1 or 2 other people as co-GPs.
Yes, if you have too many cooks in the kitchen, your values may not be aligned and it gets difficult. So it is important for each person to stay in their lanes, but it's also equally important for somebody else to take over in case, one person disappears for a short time, which can happen in life.
Yeah, most definitely. Interesting stuff, Sandhya. So tell me a little bit about what we were talking about before we pressed record here, and what you've seen happen over the last 5, 6 years.
So I got into this business in 2018, and all the deals I got into, whether they were passive, active, it didn't matter. And it didn't matter how well you managed them. As long as you sold them by 2021, 2022, you did really well. You probably doubled your money, in some cases tripled your money, etc., just from cap rate compression helping you, even if you poorly managed it. But if you acquired a deal at that peak of the market in 2021 or 2022, well, you were probably in for a shock, because most of those deals were acquired on floating rate bridge loans. So hopefully you got yourself what we call a rate cap, which at least limited your exposure to the rising interest rates with a like an insurance policy is what we call a rate cap.
Yeah.
And your mortgage increased tremendously. So if you did not underwrite to the max of that rate cap, your deal was probably in trouble. We've seen a lot of foreclosures happen since then. And I think a lot of people got into these deals imagining it to be the golden era, as I called it, with cap rate compression, and that did not happen. So if they didn't operate their properties very efficiently right from the beginning, many deals have gone under or having to make capital calls, member loans, or nowadays they're calling it debt funds or preferred equity funds. But
Yeah.
these
So
are big.
tell us a little bit about that. So for folks that aren't familiar with these debt funds or equity funds, what is that like? Explain it as if you're explaining it to a 13-year-old, just super basic level, if you don't mind, Sandhya. I know that's tough for your engineering mind, but dumb it down for the rest of us.
So if let's say you have a deal with a mortgage of $15 million and today you're trying to sell that deal and it's barely worth that $15 million, you only have enough
Much
money.
less the equity, the down payment you've
Correct.
had to come up with.
So,
Yes. Okay.
so all you can do is pay off that primary lender. You have no money left to pay back your investors. So the deal is what we call underwater, meaning investor equity is completely wiped out. To save such a deal, you have to hold on to it for a little bit longer, let's say 2027, 2028, so that you're hoping for interest rates to come down and therefore the property values to go up, therefore the buying power of a buyer to go up because of lower interest rates, so that you can get some equity. So maybe instead of 15 million, you could sell it for 18 million in a few years, and therefore you'll get that 3 million of equity to pay back
Maybe
investors.
break even. Yeah.
Right? Maybe
Right.
break even, that too. So what these sponsors or general partners are doing on such deals which are underwater is they try to raise equity so that they can either buy a rate cap or try to refinance this deal to cover that gap and hold on to it for a little bit longer. But now you're putting as an investor good money into what might be bad, meaning the deal is underwater. The deal is barely able to survive. It's on a negative cash flow. So imagine you're a household and you have all these bills to pay, but the paycheck you're bringing in is not enough to cover all your bills. So you're in what we call negative cash flow every month. And so when you're trying to get a debt fund at a high interest rate, they're making these debt funds look attractive. They're giving you a teen percentage in interest on those loans so that you feel like investing in it. But what is backing it? What is behind that loan for you to get paid back? Well, it's a failing, troubled asset. And so be very careful getting into such a deal because I don't think that asset is going to do significantly better in its operations to be able to pay you and pay all its other obligations.
Yeah. So in your analogy there with a household that's not making enough income to cover the bills, it's almost like them using their credit card to
Correct.
bridge that difference, right? And
Exactly.
you're
Yeah.
gonna have to pay
When do
the
you ever
piper.
pay that credit card debt back in full and all the interest owed for it?
Yeah. So Sandhya, what's your understanding under those situations with these debt funds and whatnot? If the you know what hits the fan in a few years, who gets paid out first, the original investors or the new debt investors? Who's more secured there?
The very first person who always gets paid is the primary lender.
The bank, of
And
course. Yeah.
And after that, this new stack of investors putting money into these debt funds and equity funds, they get paid first. And then only much later, the original investors who trusted this person and this deal 3, 4 years ago. So usually the original LPs, limited partners, are the ones that get hit the hardest and are very unlikely to get their money back.
Yeah. Yeah. So based on all of this, are you seeing opportunities in your local market for going in and scooping up some of these properties, not like a debt fund, but actually like buying them out of foreclosure and things like that?
We've looked at some deals that have been offered at a much lower price. Now, brokers are still trying to position it as what a great bargain. It's 20 to 30% less than its pricing in 2021. Well, that's today's market value. It's not like I'm getting a discount from today's market value. So there are deals that are getting sold close to that loan amount. And so you still have to have solid assumptions on things like rent growth. I'm very familiar with the Dallas market, and rent is your primary bread and butter for a property. and the rents are mostly flat. So there's very few deals, especially if a syndication group has been buying it every 2 to 3 years and doing a spin, as I call it. There's very little meat left on the bone for those deals to have significant improvement value in terms of rents and other income. We've had an oversupply of properties in the Dallas area in terms of build, new construction. So that's getting absorbed throughout this year. And so we believe it's going to be about 2026 before we can see any significant rent bumps. So you got to be very careful in your underwriting assumptions to try to make money even on these deals. I've looked at about 35 deals so far in 2025, and the best cash flow I can see from those deals to a passive investor, not the general partner, because they may take fees, right? General partners take acquisition fees and they get splits, etc.
Yeah.
But a limited partner, they're only getting about 3-4% in cash flow, rarely more than 5%. So just because a deal says it's an 8% pref, that doesn't mean you're going to get $8,000 for every $100,000. It means that they're going to try to catch you up to that. But year one, you may only get $3,000. So that remaining $5,000 is going to keep accruing, and they're going to pay that before they pay themselves. So a pref return is not a guarantee. None of these returns are guaranteed. So you are taking a chance. So I haven't seen deals that pencil enough for me to jump in. And I've actually divested to a couple of other asset classes in parallel in the meantime. So in 2023, I got into oil and gas for tax benefits. And I'm also into technology funds, being a technologist myself in the background. So for a diversified portfolio.
But more on the passive side, I'm guessing, in those areas.
I'm also raising investor capital now for it, having been passive, which is something I do. I always do passive first and see if I can trust the operator or that asset class, etc., really understand it. So I've done both since 2023. So in 2025, I'm also doing it on the active side.
Nice. Interesting. So when it comes to raising capital, you have an engineering background, Sandhya. So do you tend to attract those kind of people as your investors?
I tend to attract people who are more data driven for sure. I'm not as soft, warm, and fuzzy and telling you everything is going to be okay. I'm going to give you my answers and numbers and say, this is why I believe this has great returns. I'm more logical than the warm and fuzzy. And so if you need warm and fuzzy, I'm going to say, come visit a property with me and I'll tell you what I do. And hopefully that gives you confidence.
Yeah, that makes sense. Interesting stuff. All right. So what are your plans for the rest of the year or the next 12 months?
The next 12 months, continue to underwrite every deal that comes across my table in a great location with low crime, etc. And if it meets my buy box, and brokers know this from my transactions with them, I will make an offer within 48 hours because I know my market that well. I know what rents I can get. But in parallel, I am raising capital for funds like oil and gas as well as technology, continuing to trade stocks and doing options because those, just like, every asset class has its cycles. Real estate is a little bit down the last couple of years. So let's see if our crude oil pricing can help us on the upswing with that. And technology is more for long-term growth. So I used to have a W-2. So I've taken that retirement money to put into technology funds because it's not money I'm counting on for cash flow in the near term. So I can just put it and forget it like a 401k for a few years. And hopefully it's going to return big and I don't have to worry about the tax consequences when that happens, right? So that's the sort of like my lottery ticket, but a little less of a gamble because I've studied the technology. But those are my plans.
You don't sound like the kind of person that gambles.
Yeah, it's a buy box that meets your buy box, just like with anything else. And with oil and stuff, you hear of Ponzi schemes and things across all of these. So how do you make sure that's not happening? So you want to make sure you have transparency with bank accounts whatever kind of deal you get into. You want to have bank statements to correlate if you're underwriting a deal and they publish a T12, you want to make sure in your PSA, you're including that bank statements must match what is being reported. So same with oil and gas. I want to be able to see all bank statements and I want to see how my money getting wired is actually going to buy that specific well in that county as an example of tracing it. Just like I want to trace that address, I want to know the deal closed on this day and the county records reflect that purchase for real estate.
Yeah, makes sense. Sandhya, I'm sure there's a lot of people listening or watching this who'd like to connect with you. What's the best way for them to do that?
Find me on LinkedIn. I post a lot of content on a variety of asset classes. And of course, connect with me through Dave. He's got all my contact info.
Awesome, Sandhya. Thank you so much for being on the show.
Thank you. This was fantastic. Appreciate it.
All right, everybody, take care. We'll see you on the next episode. Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewyou.com. Now, at moneypartnerformula.com, we help real estate investors to create a process for predictably getting capital so they can do more deals without relying on hard money lenders or the banks. We do this by building them a private capital marketing system. Now, if you want help turning yourself into a big money capital attraction machine, then book a call with our team to see how we can help. Just visit moneypartnerformula.com to find out more. All right, take care, and we'll see you on the next interview.